Fears of a government default have put the entire stock market in a hurt locker, which, believe it or not, is a dividend investor's dream come true. Right now, there are dozens of deals to be found on the market and tons of stocks that are sinking in share price. But in this video, there are 5 in particular we'll be focusing on that look like exceptionally good buys as we head into the month of June. But before we get to those, in case you're new to the channel, my name is Ryan Williams, and here we strictly talk about dividend stocks and how you can invest in them to create passive income and reach financial freedom. So if you love dividend stocks and if you're on a mission to retire early, then hit that subscribe button. I'd love to stay in touch as we both continue to grow our portfolios and collect that cash flow. And now moving on, the first stock on our list today is Sonoma WSM, who just reported some pretty mixed earnings where they missed on the top line but beat on the bottom line and still reaffirmed their guidance for the year, which briefly saw the share price pop up, but this brief jump was very short-lived, and later that day the share price ended up coming back down, and overall across the month Sonoma is down 4.73%, so quite a big drop in the last 30 days. And then year to date, they are down about 0.5%, and it's come off quite a bit from their February share price highs of about $143 per share, all the way down to where it's at now, about $113.50 per share. And with that, they are inching closer and closer to their 52-week low, but right now the current valuation is looking great. First, looking at their PE ratio here, this is sitting nice and low in the single digits, 8.39, which is 35.4% below the 5-year average, so that's looking really good. And then scrolling down, their price to book is 4.06, so not the lowest, but this is 20% lower than the 5-year average, and the price to cash flow is looking really good, 6.78, which is 30% lower than the 5-year average. And switching gears and talking about the dividend, their starting yield, so if you were to buy into Sonoma today, you'd be getting a 3.15% yield, which is pretty nice, and this is also nearly 30% above the company's 5-year average dividend yield. And the rest of the dividend stats are looking great as well. The payout ratio is really low, sitting there just below 15%, and the 5-year growth rate is actually just above 15%, and it's pretty rare to see the 5-year growth rate on the dividend higher than the payout ratio. We really don't see that too often, but I'll tell you what, I'll take it. And to top it all off, Sonoma has 16 straight years of dividend growth, so their dividend stats overall are looking really good. And this is a company that I'm actually planning on adding to my portfolio. I've had Sonoma sitting on my buy list for a while now, and I was kind of waiting to see what came out of their quarterly earnings report before I decided to pull the trigger. But to me, they seem pretty well positioned for a rougher economic environment if things do continue to trend that way, but we'll see, guys. You may see me start a position here in Sonoma in the coming weeks. I'll definitely keep you posted. But anyway, moving on, the next stock is UPS, United Parcel Service, who's been at a steady decline all month long, but really fell off a cliff at the end of April after they revealed a miss on both the top and bottom line for their quarterly earnings. Looking at their share price performance, UPS is down nearly 5% just in the last month, so a pretty big drop there, and then year to date they are down just about 3%. And like Sonoma, UPS is also inching closer and closer to their 52-week low, and I will say the valuation is looking decent overall. Once again, starting here with the PE ratio, it's 15.6, so quite a bit higher than what we saw with Sonoma, but in its own right, a 15-ish PE ratio is really not too bad. And still, this is about 5.5% lower than the company's 5-year average PE ratio. And then scrolling down, looking at the forward price to book, this is 6.62, so decently high, but at the same time, this is nearly 60% lower than the company's 5-year average price to book. And then last but not least, looking at the price to cash flow, 11.39, which is really not too bad. I mean, we'd prefer to see that in the single digits, but it's not terrible. And interestingly enough, this is a bit higher than the 5-year average by nearly 4%, so that's definitely something to keep in mind. But anyway, switching gears and looking at the dividend, right now the yield is actually decently high, sitting at 3.86, which is about 25.6% above the company's 5-year average yield, so a nicer cash flow return today. And the rest of the dividend stats are looking great as well. The payout ratio is sitting right there in the sweet spot, about 50%, with a 5-year growth rate that's really nice, 12.5%. We love to see those double-digit 5-year growth rates, especially when paired with a yield that's nearing 4%. Really like to see that. And they have a pretty nice dividend growth history as well, 13 straight years. But diving a bit deeper into this, they've actually been making consecutive payments for the last 22 straight years, so a little bit longer history there. And it looks to me, if we look at the dividend history chart, the only year where they really didn't grow the dividend was right here between 2008, 2009. But otherwise, that dividend growth history has been very consistent. But anyway, guys, moving on to the third stock of the day, we're talking about Archer Daniels Midland, ADM, and this is the first time I've ever talked about this company on the channel, I think. But anyway, in contrast to UPS, ADM actually reported some pretty solid numbers for their most recent quarter, with revenue in line with expectations and a beat on earnings per share. Yet they are still down about 6.5% in the last month, so a bigger drop than the first two companies we've seen, and then year to date they are down a whopping 19%, geez. And as I'm sure you can imagine, this puts them extremely close to their 52-week lows we can see on the right-hand side of the screen there, and the valuation overall is looking pretty attractive. Looking at the PE ratio there, 10.5, really nice PE ratio. Love to see that. And this is also 22.5% below the 5-year average. And scrolling down, looking at their price to book, it's sitting at 1.64, which in its own right is a nice price to book. But with that said, it is 7.6% above the 5-year average. We won't read too much into that. I really like the price to book where it's at. And the price to cash flow is looking great as well. 9.2, sitting nice and low there in the single digits. Now, regarding the dividend, out of the 3 companies we've talked about so far, I will say these are the least exciting, at least in terms of yield and dividend growth rate. As you can see in both departments, it really doesn't jump off the screen at you. I mean, the yield is only 2.5%. The 5-year growth rate is only 5.3%. But what they lack in yield and growth rate, they certainly make up for in consistency and reliability. Because according to Seeking Alpha, they've been growing this dividend for the last almost 30 years. But I actually don't think this is quite accurate. I do believe, and correct me if I'm wrong in the comments, I do believe Archer Daniels Midland is a dividend king. But anyway, moving on to the 4th stock of the day, this one is ABBV, who started tanking last month after their quarterly earnings and has been in a steady downward slump since then. Just in the last month, they are down nearly 16%. You see it really kicked off right here at the end of April. And then year to date, they are down about 14.5%, almost there. And then in the last 365 days, they are down nearly 7%. And they're getting pretty dang close to that 52-week low there, well within, I'd say, about 5% or so of reaching it. And I'll tell you what, as an ABBV shareholder, I'm particularly excited about this one because the dividend yield is officially back up over 4%, bringing double trouble to the dividend department. Not only do they have a super high yield, 4.2%, but that 5-year growth rate is really high as well, 14.5%. And they have a decently respectable dividend growth history, 9 straight years. So they've been growing this dividend pretty much ever since they spun off from Abbott Laboratories. Now, I would love to add some more to my ABBV position, but with an average cost per share of $114.20, I think it still needs to come down more before I begin buying again. And right now, I'm still sitting above a 20% share price gain. So that's pretty substantial. And on a total return basis, I'm up over 30%. But anyway, moving on to the 5th and final stock of the day. This one is Domino's Pizza, which you really don't hear me talking about too often. But Domino's basically dropped 10% just in a day after reporting what seemed like pretty solid numbers for their quarterly earnings. But anyway, in the last month, they are down 7.35%. You can see that right here, they really dropped in share price. And then year to date, they are down 10.3%, which has them getting pretty close to their 52-week low there. Now, looking at the valuation, at first glance, this may not seem that great with a PE ratio of 23.1, but Domino's is a company that is seeing a lot of growth. And so typically with that, you'll see a higher PE ratio, so it may be justified. And still, their 5-year average PE ratio is even higher than it is today. I mean, the 5-year average is 30.6, so right now it's 24.5% below that. And now switching gears, looking at the dividend yield, you guys, I know a 1.6% dividend yield is not going to knock your socks off, but still, this is 64% above the 5-year average dividend yield. That's pretty crazy to see. And the rest of the dividend stats are looking great as well. Really low payout ratio, below 35% there, with a sweet 5-year growth rate, 18.5%. That's the highest we've seen today. And their dividend growth history is not bad, 9 consecutive years. And with that, guys, those were the 5 stocks that I really wanted to hone in on, but still, there are so many great stocks out there that look like pretty sweet deals as we head into the following month that I think you need to keep your eye on. The first one is Starbucks, who has dropped 10% just in the last 30 days, which puts them officially under $100 per share, which is nice to see. And then looking at their year-to-date performance, they are down 2.4%. And moving on, the next one is Target, who is down over 14% just in the last 30 days. So really big drop there. And I know at least a certain portion of the share price decline has come from some boycotts surrounding the company. You guys may have your thoughts on that, and that's totally fine. But more than anything, I'm just trying to show you a potential opportunity to buy a nice dividend king at somewhat of a discount. But anyway, year to date, that puts Target at a near 8% loss. So once again, guys, it could be a potential opportunity. And then next up, we've got Realty Income, who is down 5.2% in the last month, sitting officially under $60 per share, which is where I know a lot of you guys like to start buying. And then year to date, they are down 7.8%. So a pretty big drop so far in 2023. Anyway, next up, another real estate investment trust, WP Carey, who is down 7.6% just in the last 30 days, which puts them at a year-to-date loss of 13.4%. And I might have to start swooping up some more shares of WP Carey. That's looking pretty good. Anyway, next up is Johnson & Johnson, a legendary dividend king who is down 6% just in the last month, which puts them at a year-to-date loss in the double digits, about 13%. Anyway, next up, another dividend king. This one has just been beaten down to smithereens, guys. We are talking about 3M, who is down another 9% just in the last month. And then year-to-date, they are down over 21%. Anyway, next up is UGI Corporation, who is down 19.5% just in the last 30 days, which puts them at a year-to-date loss, getting pretty dang getting close to 30%, and they are right there at their 52-week low. And the next up, guys, we've got Tyson Foods, who has dropped another near 15% just in the last 30 days, which puts them at a year-to-date loss just about 19%. And then the second to last one is Qualcomm, who is down nearly 13% in the last 30 days, which puts them at a year-to-date loss, only 5%, not too bad, but you can see that they're really trending down in share price, really steady downward slump. And then last but not least, guys, we've got Walgreens Boots Alliance, who is down 15% just in the last 30 days, which puts them at a year-to-date loss of about 19%. So really big drop all across the board. And taking a quick look at their dividend stats, actually, look how high that yield is getting, guys. 6%, actually 6.25%. That's unbelievable. And with that, if you want to learn about another super high yielding dividend stock, then check out this next video right over here, where I'm telling you about one that is yielding 10% and it is firing on all cylinders and looks like a great pickup right now. I just added some more shares of this stock to my own portfolio, which I'm telling you all about in this video. So click right over here to check it out, and I'll see you in the next one.